Imagine walking into a bank, asking for a $50 million loan, and having the loan officer smile, shake your hand, and offer you an interest rate lower than what the average American pays on their used Honda Civic. You have no salary. You have no traditional income. On paper, your bank account looks surprisingly modest, yet you walk out with the cash. To most people, debt is a trap. It is the monthly credit card bill that keeps them awake at night. It is the weight of a 30-year mortgage. But to the ultra-wealthy, debt is something else entirely. It is a shield. It is a legal, highly sophisticated mechanism used to accumulate massive wealth while paying virtually nothing in taxes. This is not a conspiracy theory. It is standard operating procedure. And once you understand how it works, you will never look at a billionaire's wealth or your own finances the same way again. Right now, we are living through a strange economic paradox. The average consumer is pulling back, squeezed by inflation and high credit card rates. People are told to save, to cut back on lattes, and to pay off their debts as fast as humanly possible. The conventional wisdom is clear. Debt is bad. If debt is so dangerous, why are the smartest financial minds on the planet intentionally drowning themselves in it? Elon Musk, Jeff Bezos, Larry Ellison do not fund their lifestyles by waiting for a bi-weekly paycheck. In fact, many of the world's top CEOs take a symbolic salary of just $1 a year. This leaves us with a glaring contradiction. That if they do not take a salary, they rarely sell their stock, then how do they buy mansions, mega yachts, and private islands? The answer lies in a strategy known on Wall Street as buy, borrow, die. To understand the system, we have to look at how it breaks down into 3 distinct phases. Phase 1 is buy. More accurately for founders, build. Let us use a hypothetical example. Meet Clinton. Clinton starts a tech company. Over a decade, that company grows exponentially. Clinton owns 10 million shares, and today, those shares are worth $100 each. On paper, Clinton is a billionaire. His net worth is exactly $1 billion. But here is the catch. Net worth is not cash. Clinton cannot spend a share of stock at a grocery store. If Clinton wants to buy a $50 million penthouse, he has a massive problem. If he does what 99% of the population thinks he does, which is sell $50 million worth of his stock, the financial system immediately triggers a trapdoor. The moment he clicks sell, he triggers a capital gains tax. In many jurisdictions, that means losing 20 to 30% of that money straight to the government. To get $50 million in cash, he would actually have to sell roughly $65 million of his stock. Worse, selling a massive block of shares signals to the stock market that the founder might be losing faith in the company. The stock price drops. Clinton loses even more wealth. So, Clinton does not sell. Then he moves to phase 2, which is borrow. Clinton walks into a private bank. He offers his $1 billion stock portfolio as collateral. This is called a securities-backed line of credit, or SBLOC. The bank looks at his stable, booming company and says, "We will gladly lend you $50 million. Because your stock is so secure, we will charge you a rock-bottom interest rate. Let us say 3%. Think about the math here. Clinton now has $50 million in cold, hard cash. But because this money is a loan, it is not classified as income. The IRS cannot tax a loan. Clinton pays 0% income tax on $50 million of spending money. Meanwhile, his remaining $950 million in stock continues to grow at 8% a year inside the market. He is gaining wealth faster than he is accumulating debt. This brings us to the hidden mechanics of the system, the structural flaw that separates the wealthy from everyone else. If you take out a loan, you eventually have to pay it back with money you earn from your job, which is already heavily taxed. Clinton does not have that limitation. His debt simply accumulates, compounding at a tiny interest rate, while his investments compound at a much higher rate. But how does this loop actually close? How does he avoid eventually facing the music? That is phase 3. Die. When Clinton eventually passes away, he leaves his estate, now worth billions, to his heirs. Under current tax laws in many developed nations, something miraculous happens to his assets. It is called a step-up in basis. When his children inherit the stock, the financial ledger is effectively wiped clean. The original price of the stock is adjusted from its historic low value to its current market value on the day of Clinton's death. The heirs can now sell a portion of that inherited stock to pay off the bank loan entirely. And because of the step-up in basis, they pay zero capital gains tax on decades of growth. The bank gets its money back with interest. The heirs keep the vast majority of the empire. The government gets nothing. The loop is seamless. It is a legally sanctioned perpetual motion machine for capital. This strategy is often presented as completely risk-free, as if it is a cheat code for life. But reality is rarely that cooperative. There is a profound difference between the hype of the borrow loop and the actual economic reality of executing it. The entire system relies on one critical assumption: the asset must always go up. If Clinton's tech company suffers a catastrophic year and the stock market crashes by 50%, the bank does not sit idly by. They look at the collateral protecting their $50 million loan, and they get nervous. This triggers what is known as a maintenance call, or a margin call. The bank contacts Clinton and gives him an ultimatum: either deposit more cash immediately, or seize his stock and sell it themselves to cover the loan. If Clinton does not have the cash, the bank forces the sale. The very event Clinton spent his whole life trying to avoid, the massive tax hit and the public destruction of his stock value, happens all at once, under the worst possible market conditions. We saw flashes of this reality when Elon Musk acquired Twitter, leveraging billions of dollars of his Tesla stock to secure funding. The market fluctuated wildly, demonstrating just how volatile these high-wire acts can truly be. It is a game of chicken played with institutions that have no institutional empathy. The broader implications of this system extend far beyond the bank accounts of the ultra-wealthy. This loop fundamentally alters the structure of the modern economy. When the wealthiest citizens do not need to sell assets to live, capital becomes stagnant. It concentrates at the very top, moving from generation to generation without ever entering the velocity of the normal economy, the cycle of spending, taxing, and public reinvestment that funds infrastructure, schools, and healthcare. Instead, banks create massive pools of credit tailored specifically for asset owners. This creates an economic system where access to cheap money is determined not by your potential to create something new, but by the sheer volume of what you already own. The system is not broken. It is working exactly as it was designed. It is an architecture built on the premise that labor is taxed heavily while capital is protected at all costs. Most people spend their entire lives working for money, trading hours for dollars, and paying a premium for the privilege of doing so. Meanwhile, the people who run the world have learned a completely different language. They realized long ago that true financial freedom is not about how much money you make. It is about how much money you can convince a bank to let you use. We are taught from childhood that debt is a dangerous vice, a sign that you are living beyond your means.
But as it turns out, the ultimate luxury in modern capitalism isn't owning everything. It's owing everything. Disclaimer: this video is for educational purposes only and does not constitute financial advice. Please consult a qualified financial advisor for advice specific to your situation.